Okay, perfect. So, Eddie is joining us. Wonderful. Eddie, how you doing? Just connecting. Great. So, Eddie, Eddie, you there? Eddie's there. Okay, great. So, the first bit I want to run through, this is really, really, really important, is when we say that the market is open 24 hours a day and 5 days a week. But I just wanted to let you know, people get this wrong all the time, and it can really affect their trading. So these are what are called session times, and all these times are based on GMT. Now, in the winter and summer, when our clocks change, obviously these times can change slightly. So why is this important? So when you think about big institutions or big banks or hedge funds, or these big players in the market that have the ability to move currency price, if they're shut, if they're not at work, then they're obviously not putting liquidity into the market and creating any volatility for us to trade. So knowing when markets open is really important, because we want to be trading when the banks are in the market, so we can get more more volatile moves, which can get us to profit quicker. So Sydney always starts off opening up first. So over the winter time, they open at 9 o'clock, close at 6 a.m. our time. Tokyo's just behind that. They start at 11 p.m. and they close at 8 a.m. our time. London, we open, our session is one of the biggest sessions in all of Forex. Starts at 8 a.m. in the winter and it closes at 5 p.m. Then New York opens at 1 p.m. our time and shuts at 10 p.m. our time. So you can see on the London and New York session, we do overlap. So sort of 1 o'clock in the afternoon to like 3 p.m. is a very, very volatile time to trade. It's really good. It's when a lot of the pro traders will come in and do their educational sessions. So you may have realized that, like Manny, he will trade at this this overlapping time. So between London and New York overlap. In the summer, the times change slightly, and you can see that in the table below. But really, this is something I'll send to the group. But I trade every single day in the morning, so I'm on the charts either at 7 or 8 a.m. in the morning without fail. So I want to catch the London opening. If that doesn't work for you and you're more of an afternoon kind of person, whatever, trying to fit in a time where the market's open is when there's the most amount of cash into the market. So that's where you get your big moves. So just wanted to clarify that with everyone. So Eddie and Naylor, can I just check? Have you got Stinu? Do you know I put it in the group earlier? STINU. Did you download it?
Yeah, I did manage to download it.
Perfect. And Eddie, have you got Stinu?
Hello, can you hear me?
I can hear you now, Eddie. Yeah.
I've just got back home. I wasn't able to download it.
Okay. All right. We're going to be using it at the end of the session. So do you want to? Can you download it now?
Yeah, sure.
Yeah, it's free. It won't take too long.
All right.
Perfect. All right. So what I'm going to do now is I'm going to move on to candlesticks. Now, candlesticks is something you will. Hold on. What screen can you see? Can you see just a normal screen?
The directional bias on the daily 4 hour, that one. Candlesticks.
This one, yeah.
Yeah.
Perfect. So I'm going to go through what candlesticks are and why they're so important. But we know, hopefully, that the candlesticks are what we call the movement in price. So that's how we track the price in the markets. On a really high time frame, so on like a daily or a 4-hour, the candlesticks at certain points in the trend can tell us, like they can give us clues as to what's going to happen next. It's otherwise known as like the language of the market. So, you know, obviously we're all looking at its numbers and figures and stuff, but when the market makes patterns, you know, that's the market telling us what it's gearing up to do. So on these high time frames, which I'll show you in a moment, we can see these different candlestick formations, and that can then signal, maybe not right now, but in the future, that a certain currency pair is going to go bearish or bullish. That's the idea. The candlesticks themselves, you know, they all differ in lengths and they have widths, and some don't. Some are small, some are long. That really indicates the volume and the momentum of buyers and sellers. Okay, and when there's any indecision, which I'll show you shortly as well, it can show you when they're actually battling. They're trying to get control, and they're sort of playing tug of war. So all of that we can tell from the candlesticks. Now, the patterns I'm about to show you, it's more about where they are in the market rather than just being in the market. So you'll see these formations everywhere, but it's us trying to pinpoint exactly where they are, which will then give us that directional bias. So what we really want to do is try and find these at the top or bottom of an SRT level. SRT, support, resistance, trend level. That's where liquidity is built up. Okay, liquidity is where people have placed an order and they've put a stop loss in. Then that's where the banks try and target before they make their move. We're smarter than that. You know, we wait for our confirmations to line up on the source strategy, and we only enter when it's ready, not when we think it's ready. We let the indications of the strategy tell us when to enter. You also will find these at different fib levels. So if you haven't done Fibonacci yet, don't worry too much, but the sentiment's the same. Again, you want to see certain patterns at certain levels in the market, because these patterns can tell us that the market's about to reverse, which is then when we want to start looking at entries. And you also could see them at higher highs or lower lows. So again, just different structure levels, but throughout the market. So basically what it represents is, again, it's the language of the market giving us clues. It's telling us with a trained eye that there could be a reversal. So I'm going to show you the patterns in a moment, but when you see one of these, it's a clue. You know, it's a subtle clue that, right, the market's exhausted, or it's going to reverse, or there's a change in momentum, etc. When it comes to buying and selling pressure, that can sometimes mean the amount of orders that have been placed. So let's say it's a double bottom and you've got a trend line, you know, that's bounced a couple of times or whatever, and it's now coming for the third hit. And all of us retail traders know that's a really good time to buy or sell, whatever. We all start placing orders. Well, then that can increase that candle length. But the institutions do that the most. So when a bank, see like a banking level, and they flood the market with their cash, you know, that's where you see this pressure really just taking off. And hopefully I'll show you that in the next slide. So these are the candlesticks I really like. It's what Manny goes through in the sessions that you're watching. And I just want to reiterate them really, because they're really, really useful. So we have here a bearish engulfing. So what we mean by engulfing, the red is the bearish. These are all the sellers. And this is consistent throughout. And the blue are the buyers. So the blues are racing up. And then the very next candle, the sellers took over and they engulfed the blue, because the body of this candle was bigger than the blue one. That's all it means. It means that this red candle holds more orders and momentum than the previous upward candle. It's exactly the same in reverse when it comes to bullish engulfing. So we would have a downtrend potentially where the market's being pushed down, and then very next candle you see a big strong buying power next. Okay, that is simply an engulfing candle. Now you can have tweezers, which Manny really likes. He talks about quite often, and the wick can be either at the bottom or at the top, and that will indicate whether it's going to go up or down. So on this one, this is a bullish tweezer pattern because there's been buying power. The wick suggests that it's exhausted, like the market's tried to come down and it can't hold that price and it's pinged back. It's done it again here. So push down, push down, push down. It can't hold the price. So the wicks show you that the market's been tried to be forced into that direction, won't allow it. So the next one you can expect to see a bullish push. Railroads are kind of the same thing as tweezers, but these can be any way around too. So if you've got a red to a blue, it just means that the market is basically saying, in this example, the blue's pushing up. The very next candle is to completely counteract it and knock out that momentum. This is like a manipulation. This is often seen when the hedge funds and banks are in the market and they're trying to control price. They're trying to create patterns. They're trying to keep price at a certain level so that they can make their move soon. This is one of my favorites. So you've got a morning star and you've got an evening star. So the morning star is bullish, evening star is bearish. Now I've learned and I've heard of many, many ways that people remember these two formations and how they remember it. I remember it by thinking that in the morning, the sun is at the bottom and the sun comes up. So I think about this doji, it's called, this high, loads of wick and hardly any body, it's called a doji. If the doji is at the bottom, it means, you know, that's the sun coming up. When it's at the top, the sun's going down. So in the evening, the sun goes down. So, hey, that's just how I remember it. People have their ways, but that worked for me. So when you see, again, a push down, a doji, which means there's indecision, and then a strong bearish push up. So remember that push up is bigger than the selling candle. So that type of pattern there, that 3 consecutive pattern, you know, 9 times out of 10, the next candle will open and be bigger than the blue candle before. So a really good time to enter. It's the same in reverse in the bearish. So you've got the big push up, indecision, and then the huge momentum shift down. Okay, so we're talking about shift momentum, reversals. You want to be spotting these at the top and bottom of trends. Now these next two are all about when the market's completely indecisive. So if you imagine these are on the daily, let me just let Fiona in. So imagine that these are on the daily or the 4-hour time frame. You know, there's an awful lot of space in between here, a lot of price range. Get indecision on a daily basis or 4-hour basis is quite unlikely. So when you see that happen on a high time frame, these are called spinning tops. These are called spinning tops. So when you see this, it basically means that the market, if that's at the top of an uptrend, you know, that's telling you that price is exhausted. It's not really going down. It's not going up anymore. It's just collecting orders. It's essentially a position where it's just about the top of an you've also got a double doji. Oh, guys, just I'll just wait for Luke to connect. Sweet. So, guys, those of you that jumped on late, no worries. I have recorded it, so you can go over the first 10 minutes or so to catch up on what you've missed. You've not missed much yet, which is good. The old double doji. So this is kind of like the spinning top, but with even more indecision. So when you're seeing this on a high time frame, again, it's an indication that price is going to reverse. Imagine we're at the bottom of a downtrend. You see these two type of signs next to each other. That's 2 days worth of, you know, momentum just stalling, just completely stopping. No one's in control. momentum's out the market, and a good chance to see a reversal. You've then got a hammer. So a hammer is a bullish pattern. So you normally see a long wick to the bottom, small wick to the top, and kind of a small bodied candle. So what this indicates, if you think about it, if you're holding that at the bottom of the wick there, that's what's sort of insinuating a hammer. But this is where, look, if you think about what a candle shows us, the wick shows us that price in that time frame has been there. You know, it has got as low as these points, but it couldn't hold that price. The majority of the momentum is right at the top of the body of the candle here. So I kind of think about it like a slingshot. So the wick is the slingshot, and then it stops there. The price ends on that candle at that time, and the very next thing is if you let go of that slingshot, it's going to propel the price forward. So that's kind of how I think of a hammer. This is a bullish pattern where it is expected to be up. So you see that at the bottom of a downtrend. Now you're in a good position. That's a very, very good sign that, you know, the market's going to reverse and going to go bullish. The opposite, it said the shooting star, which is the bearish version of the hammer. Again, if you think about a slingshot and you've reached the end of the day or the time frame, and you've got majority of the weight in the bottom and you've got the spring at the top, and you let go, it's going to fly down. That's the philosophy in reverse for the shooting. Now the 3-pin pattern is, I use, this is a really good one for the note takers out there. So the 3-pin pattern for me is really good for identifying a higher high or a higher low, so like a swing point in the market. So what it shows is that, you know, the wick and the body, they can be all different lengths and sizes, but there's one fundamental rule, is that the wicks need to grow this side and then fall immediately the side after. So when you have this low, high, lower sort of formation, that really indicates that price either side, so top or bottom of a trend, is about to reverse. All right, so I'm going to get into like a bit of a diagram about spotting these, but I've used an engulfing candle as the example, but really you can replace that with any of those formations I've just shown you. So let's take a look. So again, reiterating on a daily or a 4-hour time frame. So say we're doing top-down analysis, which is where we're looking at the market in on a daily time frame or a high time frame on a 4-hour, and you see a clear trend up. Okay, then maybe you're looking at the market here, and at the start of the day, huge bearish engulfing. All right, obviously none of this has happened yet because we're looking at it live. So this would indicate to me that because the market now has shifted in momentum, I'd be looking for price action to take us to the downside. So obviously you'll learn with your structure training that you're waiting for the break of structure. Okay, so the trend is broken. You'll be looking at the scanner source strategy to indicate entries. But then this big push down, let's say it broke this previous low, which is the first indication that the price is going to change, breaks the low, pulls back into that type of zone, so it's called a price reversal zone. And then we're looking for one of those characteristics in candles again. So do we have a bearish engulfing? Do we have a morning star? Sorry, an evening star? Do we have a shooting star? Is there something there that, you know, is going to prove to us in the candles that we're going to be bearish? You've also got the scanner source. You know, the scanner source does all of this for you. But I want to just explain to you what the candles do when you're looking at back testing maybe, or you're looking at the setups for the week. You've got a better trained eye than most, right? Because candles are really, really important. So you're then looking for that entry to then take the market lower. It's exactly the same in reverse. So we have downtrend, downtrend, and then we come to the daily and see something like this. You know, strong shift in momentum, push the opposite way at the bottom of the downtrend at a lower low, you know, and then the market continues up. So we've spotted that and thought, right, this could turn bullish. We see the market career up, break the trend line, create a new high because it's knocked out the previous high, and then start pulling back. So at this point, we're looking for another trigger, potentially in candles. This is how some people just trade. They just use candles. They just use price action and structure. They don't use indicators. So we're lucky. We're learning the scanner source, which is going to identify these things for us and just make you even more prolific. So hopefully, just to recap what candles are, they're the language of the market. They're there to explain, you know, the essence, the direction, the directional bias, the volume. The big candles hold more volume than the small. The wicks show us that the price is forcing its way in the direction and the market can't sustain it. So all these things give us clues over time. Your eye will just see it. It's amazing, really. And again, you want to see these patterns at certain points in the market. So in the middle of a trend, no point. It needs to be at a swing low, swing high, or at a support and resistance level. Starting to see price action where candles are making these formations. Layer your scanner source strategy on top, and I promise you, you'll be onto a winner. Absolutely onto a winner. So I'm now going to move on to risk management, which was where we'll spend the next sort of 20 minutes or so. But any questions on candles, anything you've noticed when you're marking up charts, anything that I've just gone through there that's gone sailing over your head, or is everyone happy with that? Just drop a 1 if that made sense. Lovely. Candlesticks, they're integral. You need to know what they're all about. Spotting patterns will only help you, and yeah, enjoy the candlesticks. So right next is I'm going to look at risk management. So you know me, I like a few rules. So rule number 1. First of all, what is risk management? Risk management is you being in control of money. Simple as that. If you're not in control of your money, the banks will be, and the banks will probably win. Okay, so what do I mean by risk management? So I put in the group that we're going to talk about pips. Okay, so we're going to do some ways of calculating pips. Okay, and for risk management, all we really are concerned about is what our pips or stop loss are. Okay, the take profit, you're in profit. Okay, so you're not at risk, you're growing your account if you're in profit. So risk management is all about, if you hit the stop loss, you have to be prepared to lose that money. Okay, so the stop loss is there to protect your account. Sorry, I've just had about 100 messages through. Back. So we're going to look at calculating pips or stop loss. Obviously, the importance of stop loss is there to protect your account. And when you can do this effectively, You know me, I like to talk about mindset. It really is key. So your mindset. So calculating your pips to stop loss, it's there to protect your account. And having effective risk management means that your mindset's not going to disrupt your analysis. So what do I mean by that? So let's say you've marked up a chart and you're in for a sell. And you open up your MT4, you put your trade on, and you see the numbers ticking away, yeah? You're fine. You're in for a sell and the market goes up. Okay, that happens. That's part of the game. Sometimes it will hit your stop loss. Sometimes it will just fluctuate and then go in your direction. But the importance of your mindset, what I see a lot of people sometimes do when they're inexperienced, is they'll see it going up and then they'll put a buy on. So they'll buy the currency because they see it going up. Okay, and they've been too quick to act. And then they close the one that's going down, all right, because they're even up on their money. And then what happens to the market? It goes down. So they've hit stop loss on both. Like trust your analysis, and this is really key. So risk management is all about, you know, you being able to set the trade and forget. Yeah. So if you know, right, it's 30 pips to stop loss. It is I'm going to risk 1% of my account. You need to know what lot size to put on. So we're going to do an exercise. So drop a 2 in the chat if you've downloaded Steno. If you haven't, can you do it now? Eddie's got it. Naylor, Fiona, Luke. Okay, cool. So, Kev, just let us know if you've got it, mate. If you haven't, can you download it? Right, we're going to all do this together. So, I'm going to pretend that I've sent this to you as a signal. So I've said, guys, I've got a trade. It's fire. Like, you've got to all jump on it. You've all got to take it. All right, I'm going to say the entry is 0.96982.
I didn't get that. You tried.
Siri's getting involved. Just done it again. Right, so entry is that. Our stop loss is 0.97150. Now, I'm just going to talk about these two numbers because this is all that matters when it comes to risk management. So if I had sent this out to the group, oh, Luke, legend, just runs from that. Yeah, so Kev, the app Steno is to help you with your risk management. Okay, it's about helping you. It's a calculator for your lot size. So if you can all open up Steno for me, and you might have to put in there what your currency is, and you might have to set it up. It takes like 2 seconds. So just let me know. Just drop a 3 in the chat box when you've got this screen in front of you. Can you see that? Oh, that's reflecting. You see that? So it's basically got the pound at the top and account balance. Just drop a 3 in the chat box. I'm going to do a couple of these with you. And then I want you to practice this every single time before you put a trade on. Fiona's there. Eddie's good. Kev's good. That was quick. Good man. No, that wicked. Okay, right. So in the top box where it says pounds, just put 1,000 for me. Where it says risk, let's put 3%. Now you see the next option, it says stop loss in pips. Stop loss in pips. So all you've got from me is the entry and the stop loss. So this tool I got was from, it's on TradingView, it's on the harmonic scanner, it's on this left-hand side. A long position is a buy, a short position is a sell. You click on that. So let's say we're on this currency, which is AUD CAD. You can just come into the currency if you're not confident in working out pips between this and this. And you can just double click on it, inputs, you put in the entry, so 982 is already there, and then 9150. Actually tells you there what the pips are, 16.8. It also tells you here, 16.8, 16.8. We don't really need the 8, so it's 16, so it's 98 to the 15, because it's up. It's the 15 plus the 2 to get us to 7. Everyone follow that? So in the next box, if you type 16 pips, so stop loss in pips, 16. And then you go through to the next screen, which says currency pair. You then select the currency, AUD CAD. So you just touch AUD, then touch CAD, and then hit calculate. Right, so can you see there it says lots. It says 16, it's got all different options as well. But for 16 pips, the lot size is, I want you to put it in the chat. So what is the lot size on this currency? Risk 3%. Yes, Luke. Did you all get that? Nice one. Good, good. All right, so it looks like you all followed along perfectly. So who can tell me how much money you'll lose? It is on that screen that you're looking at. How much money would you lose if it hits stop loss? 30 big ones. 30. Yes, Naylor, you're right, 30. Good, good, good. Fab. Okay, right, we're going to practice. The reason why this is important is before you place a trade, you have to know what your lot size is. Yeah, whether it's a signal, whether it's a trade you're doing yourself, you need to know what numbers to put into MT4 that represents your risk. Yeah, what I see a lot of people do is they'll just put in 0.01. If you do that on every trade, it's going to take you a lifetime to grow your account. Like, you have to work out your stop loss pips. It was 16. You got 32062. So look, AUD CAD. Fiona, we'll do another one. See how you get on with it. All right, we'll do another one. We'll do, what should we do? NJ. Right, so I'm going to say to you, right, guys, we're going to buy NJ. Put the stop. We're going to buy NJ. So entry is 73.505. Okay, stop loss is 73.110. Right, does anyone know what can anyone work out the pips just by looking at those two numbers? Okay, if you can't, then you've got this tool that you can use, but it's the difference between the first two numbers after the decimal, so 11 and 50. Okay, 11 to 50. So that 39, it does it for us on here. So it says we're risking, our stop loss will be 39 pips. Okay, so everyone go back to Stinu. If you just press X and go to the front screen, right, I want you to put in £800, risking 2%. Okay, and the stop loss in pips, again, is 39. Next screen, NZD, JPY, calculate. So what did you all get? What did you all get? NZD, JPY, Luke. NZD, JPY. 5702. How did you get that? How did you get that? Zero 5 042. NZD JPY. Yeah. £800, 2% risk. It should be 0.057. So this is definitely the bit everyone needs to practice. Like if you see a signal come through on Trade House, or you see currency pair that you're looking at on the scanner, you know, you need to know exactly what you're willing to risk to take that trade. Change setting to lots on units. What? I never knew that was an option. I never knew. Ah, fair. Okay, so try that again then, Fiona. So 800, 2%, 39 pips, NJ. Do you get 0 points? Yeah. Nice. Have you done same here? Right. Wicked. Okay, cool. Okay. So Stinu, actually first, Cliff, have you got the same as us now? Getting the same. Sweet. Okay. Right. So can you see that if you don't know what lot size to put in, you cannot change the lot size after you've entered a trade? Yeah. So once you're in a trade, you can amend everything else, your stop loss, your take profit, You can close half your lot size or whatever, but you cannot change the lot size that you've entered when you entered the trade. You can't move it down once you're in the trade or move it up. It is locked. So getting your lot size is the most important thing when it comes to risk management. Right, we're going to do one more. We're going to do one more, and I'm going to use, actually that'd be harsh if we use gold. Right, let's go USD CAD. So we're going to be selling USD CAD. We're going to have a 10 pip stop loss. Okay, so I'm not going to tell you the entry and all that anymore. Let's get a 10 pip stop loss. You've got a £2,500 account. And you're risking 5% on that trade. 2,500, 5%, 10 pips on USD CAD. So someone tell me what lot size, tell me how much money I'm risking. Eddie's fast. Luke is fast. Kev is fast. $125. Kev was in dollars before, that's cool. You know how to change it now, that's wicked. Yeah, lovely. Right, now I'm going to test you a little bit. So we're now going to, can you see on the left-hand side, it's got different stop losses. So like you can just then cycle through, like if you want a 35 pip stop. Yeah, so what I do when I know how much I want to risk, but I'm not sure on the stop loss yet, is I'll go 2% and I'll just put in 20 pips. USD CAD, right? So I would do this as I'm looking at a trade. So I'll be like, right, I'm going to be selling this currency. I want to know what my options are for my to risk £50 to 2% of my account on this currency. But I'm not sure if it's going to be 20 or 25 pips. So if you just put that in, so put in 2% instead of 5, and then go back into the options. And once you're there, so we're now risking £50. Our lot size for 20 pips is 0.427. So when you're actually on your MT4, by the way, the last digit is irrelevant. All right, you can only put in 2 decimal points. It'll be 0.42. You don't round up, don't round down, it's 0.4. But then I want to do a 25 pip stop. It'll be a 0.342. So you can have this kind of, as you're waiting for entry, you can have your lot size. And let's say it's just moved down slightly because the market's gone away a little bit. Okay, and you're down now at, you've now got a 16 pip stop. I can tell you straight away, right, for a 16 pip stop is 0.53. But all the time, regardless of how many pips the stop loss is, I'm only going to risk £50. Yeah, so if that goes in the wrong direction, hits stop loss, £50. Yeah, it's really, really important. Okay, when we talk about risk reward in another session, we need to know what our risk is first, before we know what the reward is. Because when we're in profit, reward's great. We're all gravy. But what we don't want to do is lose too much money and then be clawing it back and our mindset affected. It's all about risk management. Know what you're risking, 50, 20, 25, I would only ever risk 5% of my account in one day. You might want to do that differently. That works for me. I know some people that risk 10, whatever you're comfortable with. I risk I'm quite cautious when it comes to risk. But when you get your risk reward right, it doesn't, it's all gravy. It's all good. So just very quickly on risk reward, this ratio here is a 2.17. That means we're risking 1 to get a 2.1 return. So that it's 36 pip profit, 16 pip stop loss. If we got that to a 3, that means we're getting 1 risk, 3 reward. So we risk 1%, 2%, 3% here, whatever it is. Say it's 1%, and we're getting 3% growth when we hit profit. Yeah. So when it comes to risk reward, we don't want to be doing things like this, where we risk, where it's negative. See that we're risking 16 pips to get 9. Nobody wants that. If you're hitting losses every now and then, your account will be going backwards. So we always want the reward to be higher than the risk. We'll cover that another day. Alrighty. So for those of you that were late, I've recorded it, so I'll send it out in the group so you can catch up with the first bit. But we covered session opening times, which I'm going to send in the group. We've covered candlesticks, what they mean, kind of what they do, where to spot different patterns of candles, to help you get an idea of where the market's actually going in any one day. And guys, don't worry if you were late. That's not a dig, by the way. It's, you know, we all have lives. It's a crazy busy time. We're coming up to Christmas. No drama at all. I know you're putting the work in. So that's why I record these sessions, so that if people miss them, they can catch up. So no drama at all. I'll pop that in the group when we finish. We've done risk management. That, I promise you, if you learn how to risk manage, I could put easily, I know comfortably, if I put all my life savings in my account, I know I can't lose it. I know I can't lose it. All right, it's people that over leverage, so they'll put like a really high lot size on a small account, and then boom, their money's gone. Like, no, it's not sustainable. So learning how to risk manage, honestly, that should be every time you enter any trade, you need to work out your lot size. That's how you do it. So I hope you found that helpful, and just practice. Working out your pips is probably the hardest bit of the whole process. So if you've got TradingView in front of you or a calculator, you can use one of these tools and just plug in the numbers. If not, calculator is always good, so just add and subtract. But tonight, my loves, that is it. So we are going to skip next week because we've got, so it's Christmas week. Probably skip the week after, but we can keep in touch on the group. So carry on going through your education, and if you've got anything pressing, then do let me know. And we might be able to fit in a session in between Christmas and New Year. If not, we'll definitely be back on the 6th. I'm ready to rock and roll 2021. I can't believe it. I can't believe it's coming in a few weeks' time. So from me, that is it for tonight. That's it for the year, potentially. So I just want to wish you all a very Merry Christmas, New Year, and yeah, enjoy the videos over Christmas. Try and keep the momentum up. And 2021, honestly, it's going to be a time for grand change. We're going to make some big changes. So thanks for all jumping on. I'm going to play you out with some Christmas music. Why wouldn't you? And feel free to jump off whenever you're ready, guys. What's that?